Hello and welcome to this programme from Baillie Gifford, the latest in a series where we talk to the fund managers of the group's different investment trusts. My name is Gavin Lumsden, I'm from Citywire, and today I'm speaking to Roderick Snell, manager of Pacific Horizon Investment Trust. Roddy is a partner at Baillie Gifford, having joined the Edinburgh-based company nearly 18 years ago. He's worked on Pacific Horizon for 10 years and became the Asia Pacific Fund's lead manager in 2021. This is a great time to be hearing from an experienced Asia investor. While a lot of attention is paid to China's slower than expected recovery from the pandemic, the region is viewed as being in better shape than many economies in the West. I'm sure Roddy will give us his thoughts on both those topics. Right, time to meet Roddy. Hello, Roddy. Thanks very much for joining us. How are you?
Very good, thank you.
Excellent. Well, listen, I'll start off with my questions, if I may. You're a growth investor. In fact, you describe your strategy as growth squared. Can you remind us what you mean by growth squared and why you still believe in it after what has been a tough 18 months for growth investors?
Certainly. Well, we believe Asia will be one, if not the fastest growing region over the coming decades. And we simply want to be invested in its fastest growing companies. So it's growth times growth or growth squared, as we like to say. And we have faith in this because it works. We've been managing dedicated Asian money since 1989, so for more than 3 decades. And we've got a very good track record over really all reasonable timeframes and through numerous market crises, political upheavals, cycles, and investment styles. And if I bring it to today, when I look at the portfolio, I'm genuinely excited. Rarely do the characteristics of our holdings look this attractive. For instance, the average growth of the portfolio is substantially higher than the index, yet the valuations of the portfolio is about the same as the index, if not a discount. And you very rarely see that. Normally we would be paying a 20 to 40% plus premium to the index, but today there is no value for that extra growth. So overall, really very happy with the portfolio, and certainly no change from us trying to find the fastest growing companies in the fastest growing region, or growth squared, as we like to call it.
Okay, and specifically, what are the long-term growth trends you've identified in Asia?
Sure, I'll probably highlight 3 key areas for the portfolio at the moment. First, we would have a big exposure to the rise of the Asian consumer, really driven by increasing wealth and positive demographics. And this is arguably one of the most powerful investment themes of the next decade, with Asia likely to be adding at least 1 to 1.5 billion people to the middle class by 2030. However, unlike the past decade, where most of these additions came from North Asia, like China, this time is going to be more from the younger countries of India and Southeast Asia, which is where we are positioned, with our 3 largest overweight countries being India, Vietnam, and Indonesia. The second theme probably worth highlighting would be the energy transition. Now, some of this we're exposed to directly with companies such as LongE Green Energy, the world's largest solar panel manufacturer in China. But most of our exposure is actually to the supply chain, be that batteries through companies like Samsung SDI, which supplies a number of key Western brands, including BMW, or through raw materials, especially copper and a little bit of nickel, which is why we have such a large position in materials in the portfolio. And then finally, innovation, which continues at a rapid pace across Asia. And we've been adding to a number of areas over the past 6 months, in particular semiconductors, where Asia is a world leader. For example, we added significantly into our holding in EO Technics recently. This is a company that supplies equipment for the drilling and cutting of wafers and semiconductors. But crucially, they focus on laser technology. So whereas today's technology is based on ceramic blades and drills, but as semiconductors get smaller and more complex, lasers will be needed, and EO Technics is arguably the world leader in this field. So we expect exponential growth from their products over the next 5 years. So those are probably the three areas I highlight at the moment: the Asian consumer, the green transition, and innovation across Asia.
Very interesting, thank you. Despite the global economic turmoil over the war in Ukraine and inflation, it seems Asian economies and some of the region's stock markets have been quite resilient. Why is this? And is it the beginning of some sort of convergence with more developed markets?
Yeah, I think that's a great question. And yes, I think it could be. And the reason is really quite simple. The macro position of Asia looks very good compared to the West. And that's really because the West has behaved actually like a classic emerging market, while Asia has been orthodox and restrained. For example, firstly, Asia didn't print money and destroy its balance sheets, stimulating during COVID. China's physical and monetary stimulus was about 10% of GDP versus Europe at 70 or 80%. Secondly, for a long time, Asia's had sensible real interest rates versus negative in the West. And thirdly, we really don't have any inflation issues across Asia. Supply chains have been okay, and there are no labour issues. People are keen and need to go to work. And finally, capital inflows into Asia and actually more broadly in emerging markets have actually been negative for the best part of a decade. So we haven't had hot money coming into the region for a very long time. And you add these up, and that's the reason why Asia has been so resilient. And to put that resilience into perspective, remember until recently, the US dollar had been on an absolute tear. It's the highest it had been for 40 years. And typically at any other time in history, that would have sucked all the money out of Asia and emerging markets, and you would have had a crisis in a number of countries. And that simply hasn't happened this time. And that's a really very strong signal, I think, for the position of Asia. And if you want to be very bullish, you might say that the US dollar has peaked, and that would be a massive tailwind for Asia, and I think actually quite likely over the coming few years.
Okay. You've mentioned three of the countries that you're overweight in compared to the regional stock market index, but just over a third of the trust is invested in China and Hong Kong, and it's been a tumultuous time to be an investor there, and many people are anxious about the Chinese market. How do you assuage investors' nerves when it comes to China?
Well, look, China certainly has its challenges. But firstly, I think it's always useful to take a step back and put the country in context, because many investors have been bearish on China for decades. But if we go back over the past 40 years, China has arguably been the greatest growth achievement, in history. In the 1980s, GDP per capita was less than Afghanistan. Today, it's the second largest economy on earth. So let's not forget this is a country with a great track record of success. And it's successfully moved up the value chain, became a technological leader, and crucially, it's been investing heavily in infrastructure, be that the largest high-speed rail network in the world or the biggest wind power generator. And now there are industries such as electric vehicles and batteries where it's clearly, I'd say, the leader in the world. Now, today, there are certainly challenges. The reopening of the economy has been softer than expected, with a weaker than expected consumer and property market, and quite high youth unemployment. But again, put that in perspective, relative to the West, actually the macro looks pretty decent in China. We're going to have probably 4 to 5% GDP growth, which is better than any other large developed economy. And crucially, they got significant room to stimulate. Let's not forget, China hasn't been printing money, and it's had sensible high interest rates, and it can start to cut. And I think there are clear signs that policy is easing, and there will be support for the private sector. And you combine that with valuations really in a distressed state that they are now, then certainly in the short to midterm, I think China starts to look actually very attractive.
Okay, and you've been taking advantage of those cheap valuations by adding to China over the past year. Could you say a bit more about which areas and companies you're finding opportunities to invest in?
Yeah, I think the key thing we've been looking for at the moment for investments is companies that are policy aligned. So we took a new holding, for example, in the past year in a company called Sylogy, which is a semiconductor manufacturer specializing in analog chips. And really, this should be a beneficiary of Western substitution, as currently about 90% of analog chips in China come from the US. As I'm sure you can imagine, China is desperate to localize that production. And Sylogy really is the best Chinese company in this space. It was founded in around 2008 by members of or former employees of Texas Instruments, which is the world leader in analog devices. So they know what they're doing. They've got a very close relationship with UMC, which is one of the top 3 foundries in the world. So they have a lot of high-tech capacity to produce their chips. And they are the largest domestic player but that still means they only have a 3 or 4% market share, so a huge growth opportunity. And we actually added relatively recently to the company. We've also been adding to a number of internet names where we think they are aligned with the long-term policies of the government. For example, Baidu, this is the search business in China. And the core search business, which generates probably $4 or $5 billion a year, is probably on a 7 times PE multiple, and that gives you the rest of the business for free. But it's these other parts of the business where we're really excited. Baidu is arguably the leader in autonomous driving technology, for example, and that's very much backed by the government. And indeed, Baidu are the only player to have a license for high precision mapping in the country, given that it's a very sensitive area. And they're arguably also a leader in AI, again, a key area for government policy. And finally, I just highlight that it's not all tech names we're finding in China. Some of the traditional names are also very interesting. The likes of Ping An, which is the largest private insurer. Again, this is an area that we think the government is keen to support, given the lack of a social security net in the country, and you're paying sort of less than 1 times price to book for a company generating 20% plus ROEs, with growth picking up. The value of new business this quarter was up about 70% year on year. So very strong results and very, very subdued valuations. So I think very good long-term opportunities there. So really adding to areas where we think there is long-term government support and valuations are very supportive at the moment.
Okay, thanks, Roddy. So let's turn to India, because by contrast, you've reduced your exposure. India now accounts for a quarter of the portfolio. Can you talk us through your view on India overall and the companies you've reduced in particular?
Sure. So we remain very positive in India. I think is the key message. As you say, it's a quarter of the portfolio and actually our largest overweight position, just ahead of Vietnam. Now, we had trimmed some stocks, and that was really based on valuations, and that was done mostly 6 to 12 months ago, and including companies like Indigo Paints or Happiest Minds, the IT outsourcer. These are great companies, but they had done very, very well. They were trading on multiples of nearly or more than 100 times PE. And we simply be finding better growth opportunities elsewhere, particularly in China and actually more recently in Vietnam. So just trimming some of those very highly rated stocks in India, where we think the valuations were too high for the growth rates that we were expecting in the next 5 years. But overall, really do remain very positive. The country has some great companies. And I'd also highlight 2 interesting developments that we see taking place at the moment in the country. The first would be that cheap smartphones have brought the internet to the masses. And that really has catalyzed, really for the first time in India, a number of genuinely innovative technology companies. And if you go to Bangalore, which is at the center of this innovation, the city really is just booming. And this provides direct opportunities for us to invest in. For example, the trust owns Daily Hunt. It's a private company, and effectively it's the short form video app, the TikTok of India. But also more broadly, this innovation could add significant growth to the country over the coming decades that's really not captured in people's GDP forecasts.
Okay, that's very interesting. And what could you say a bit more about some of the companies you are investing in India?
Yeah, I'd say the opportunities are broad, but certainly I think this bringing the internet to the masses is a huge opportunity, and we've got actually a pretty big exposure to that through the likes of Delivery. This is the largest private logistics company in the country, and really a play on e-commerce, where it's got a 50% market share in deliveries. We also own direct internet platforms like PB Fintech, which is the Go Compare of India, if you like, price comparison site, and that's growing revenues at 30-40% plus at the moment. Well, I also think that actually Reliance Industries is really very interesting. This is the company that's best known for its petrochemicals business. But actually, this is the company that brought 4G mobile internet to India and has rapidly become the biggest domestic e-commerce business. And actually, just recently, the Qatar Wealth Fund are rumored to be investing in the retail division at a $100 billion valuation. So a huge wealth creation has gone on there in recent years. And finally, I'd say there's still very positive on a lot of the traditional sectors in India that are exciting, especially infrastructure. India is finally investing again. So we own companies like Skipper, which is the largest power transmission cable company in the country. We continue to have large exposure to real estate developers like India Bulls, where we actually doubled our position relatively recently. That's an industry that has consolidated down to a handful of players, and we think it's at the start of a big construction cycle. So plenty of opportunities in India, from technology to traditional construction businesses.
Right, great. Good answer so far. Thanks very much, Roddy. But let's move on to Vietnam and another of your overweights against the MSCI All Country Asia Index. And Vietnam's your second largest overweight with about 6% of the trust. So the market was very weak for most of last year, but has done much better since November. I believe you're just back from a trip to the country. So what were your key impressions and findings?
Sure. Well, as a reminder, and as I think we mentioned many times before, the rationale for Vietnam is that we think it's the best structural growth story of any Asian economy over the next decade or two, really because it's one of the few Asian countries building up a successful export manufacturing industry, which is what you need to do as an emerging economy in order to emerge. And they've done a fantastic job of this, especially with companies looking to diverse away from China and predominantly picking Vietnam. Now, that said, and as you mentioned, the country had been very weak, particularly last year, down about 30%, really over concerns over the economy. And there are a couple of issues. Firstly, you had a corruption clampdown in the country, focused partly on embezzlement during COVID, but more importantly, a clampdown on the property sector, really related to some property land purchases that were deemed unlawful. And at the same time as that, you also had a clampdown on bond issuances to the property sector, which removed a source of funding and led to a liquidity squeeze at the property companies, which spilled over into the banking sector. Now, those issues with the property and the banks led the market, which remember is 90% retail, so very short term, led the market to get very nervous on property and the banks. The good news is that, having been to the country, it's pretty clear that these are not systemic issues. They're relatively short term in the property and the banking space, and should be sorted out in reasonable time. I'd say that doesn't mean Vietnam's completely out of the woods. There's a broader issue you see out there now from this corruption clampdown, which is really a policy paralysis. The big issue being that infrastructure is not being improved as fast as it needs to. And that is an issue they do need to sort out. If you go to some of the special economic zones, they are having, for example, power shortages at the moment. For companies like Samsung Electronics, you simply can't afford to have power outages. So it's certainly an area that Vietnam needs to address quickly. But all of these issues are being resolved. And overall, Vietnam's economy it's fine. It doesn't have inflation issues. They can cut rates, and it knows what it needs to do. So having come back from Vietnam, we've really viewed this as a bit of a buying opportunity, and have added modestly to our holdings in the country. Took a new holding in Mobile World, for example, which is the largest electronics retailer in the country. It's also building up the second largest grocery business in Vietnam. So today, I think Vietnam will be about 7% of the trust, having added to a couple of the names and that new holding in Mobile World. And overall, the long-term story for Vietnam remains very much intact.
Okay, very positive on Vietnam. What about Indonesia? You've touched on that already, but at nearly 8% of Pacific Horizons, you have been reducing the exposure. So, could you say a little bit more about what you're finding in Indonesia?
Yeah, so from a sort of top-down perspective, I think Indonesia is doing really very well. The macro looks good. They've had no major credit cycle over the past 4 or 5 years. Inflation is fine, and domestic growth looks good. And historically, Indonesia has always been the biggest beneficiary in ASEAN of rising raw material prices. If you go back to sort of 2002 to 2012, this would have been the best performing economy in the region. And today, I think what's particularly exciting is that Indonesia is flush with materials that are really needed for the green transition. This is the world's largest producer of nickel, and green energy could really transform the country. And that's helped by the fact that several years ago, the country banned the export of raw materials. So you actually need to set up processing plants in Indonesia. before you to process those materials before you export them, and that's leading to a lot of investment in the country, and the numbers are big. There's been about 25 to 30 billion dollars in FDI in some of these areas, from the likes of Cattle and LG, some of the world's biggest battery makers. Tesla rumored to be looking to invest another $5 billion into the country as well. And the scale of the things is just huge. If you go to the TKA Industrial Park, for example, out of one of the islands, this is an industrial park the size of Edinburgh. It's focused purely on making batteries, and it's all powered by renewables, hydro and solar. So big opportunities for the country in these areas. Now, perhaps counterintuitively, we have been reducing some of our exposure to Indonesia, and that's really been focused on reducing our exposure to nickel. And that's because there's probably, in our view, too much supply coming on from Indonesia. Now, that's great for Indonesia, but not so good for the companies involved. And the issue really comes down to a technology called HPAL, which is a process used to convert non-battery grade nickel to battery grade nickel. Now, HPAL has always been very, very costly and difficult, and people haven't got it to work. But it appears that the Chinese have cracked this technology, and they've been investing tens of billions in dollars into Indonesia, and will be doing the same for several years. So we don't think there's going to be a huge shortage of battery grade nickel in the next 3 to 4 years because of this transformation that's come about from HPAL. So we'll be a little bit more cautious on nickel, and hence we'll be reducing that nickel exposure in terms of the companies that we invest in.
Okay, thanks, Roddy. That's really interesting. But more thematically, but linking to the nickel topic, energy transition is top of mind for many investors, particularly around energy security. So, can you say a bit more about how you're responding to this in the fund?
Yes, we've probably got sort of 10 to 15% of the portfolio invested in companies involved in the energy transition. Now, most of that would be actually in the supply chain, so in materials. And as I say, that would mostly be copper today. We used to have quite a bit of nickel, but that's been significantly reduced. So it's mostly copper. And the rationale for that, as we discussed previously, is that we think there's a real tightness of supply for nickel. There won't be significant nickel supply coming on for the next 10 years. That's how long it takes from identifying and bringing a mine online. And if anything, the timing is getting longer. And that's going up against a demand inflection point that we see for copper. It's the world's best conductor of electricity, and the green transition simply can't happen without significant amounts of copper for transmission, electric vehicles, etc. So we think that actually the demand for copper from the green transition could equal or actually surpass the demand we saw in the last commodity super cycle when China was industrializing in the 2000s. And I say we simply don't see the supply coming on for the next decade to meet that. So quite big exposures to copper across the portfolio. The other areas got big positions in terms of the supply chain would be batteries. Particularly in South Korea, with the likes of Samsung SDI, which I mentioned earlier, supplying the likes of BMW. And then we also have some direct players like LongYi Green Energy, which is the largest solar panel maker in the world in China. Looking for new ideas continuously. We haven't actually owned many of the electric vehicle manufacturers themselves, particularly in China. We've struggled to identify who will be the winners in that space. And I preferred, as I say, to go for the supply chains of copper or batteries. But we are possibly starting to see the winners emerging in the China space, the likes of BYD cementing strong competitive positions. So looking very hard at the EV manufacturers now in China, and might be looking to add to those in due course.
Okay. Thanks, Roddy. Last question from me before we go on to the Q&A from the audience. But Pacific Horizon, you're largely investing in quoted companies listed on stock exchanges, but just over 5% is invested in unquoted private companies. I think you've mentioned one of those already, Daily Hunt in India. But yeah, can you update us on the private company exposure of the trust, and are you finding any new opportunities off market?
Sure. So with a number of our private companies, such as Delivery and Zomato, having listed over the past 12 to 24 months, our private company exposure is currently down to about 6%. That will be made up of three companies, which would be ByteDance, the maker of TikTok in China, about 2% of the portfolio. Daily Hunt in India, as mentioned, about 3%, and MicroConnect in China, which is again 1%. Now, in terms of opportunities, to be fair, there haven't been that many lately. The pipeline is certainly much weaker than it was 12 to 18 months ago. However, we did make our first new private investment in some time in MicroConnect, actually about 2 weeks ago. And this is a really interesting business. It's actually it's an exchange business for financing small and medium-sized Chinese companies who typically don't have access to formal credit. It was actually founded by the former longtime CEO of Hong Kong Exchange, Charles Lee. So someone who knows all about exchanges in the region. It's also really flush with cash, and unusually it's already profitable. And it's a really interesting model. It takes advantage of the almost entirely digital payments in China to effectively enforce daily revenue contracts, i.e. they make a loan, then they take a daily slice of the revenue from the borrower directly from their account. So it's a really neat model. It means they're relatively low risk as cash comes back to you daily from the top of the P&L, direct from the lender's account. And that in turn means that they can charge lower fees but still generate very high returns. And then these loans can be packaged up and they will eventually be sold on the MicroConnect exchange. So it's quite an early stage business. As I say, it's unusual in that it's already profitable. We think it's backed by some very impressive people, and we took just over 1% position for the trust relatively recently.
Okay, thanks, Roddy. Bit of news there then for everybody. That's great. So let's turn to the questions from the audience, and I'll start with Roddy, what has surprised you the most during the last year, either positive or negative, within the portfolio, and why?
I guess I was probably surprised the most has actually just been how operationally good the vast majority of companies in the portfolio have been. Generally speaking, I would say the majority of our holdings have exceeded our expectations in terms of growth, especially in markets like Vietnam, Indonesia, and increasingly India. But that's coupled with the disappointment that hasn't necessarily been rewarded by the market as much as I would have expected, especially given the positive macro position that I think we find Asia in today. Probably a couple of reasons for that. I think the market still is incredibly bearish or cautious on China. And also, until recently, you still had a very strong US dollar that is a significant headwind for the region. Now, as I say, I think a number of those headwinds are starting to dissipate, and in the long term, that better macro positioning of Asia will be richly rewarded. And I certainly think China, given its current valuations, it's really not been rewarded for any of the growth that it's got. And I think that certainly for the short to mid-term is well positioned. So that would probably be the biggest surprise positively has been the performance of the companies. The negative surprise has perhaps been that hasn't been rewarded yet in the multiples that people are prepared to pay.
Yeah, no, good point. And so actually that leads on to a number of questions on around some performance. So, medium term, longer term performance of Pacific Horizon, beating the index, beating the benchmark quite well, or very well over the longer term. Your enthusiasm has remained unchanged. So why should an investor have confidence that this time you might be right?
Well, I suppose, firstly, I think generally speaking, as you say, long-term performance has been very good, and indeed it's been good for many years. If you go back, we've been managing the trust for two or three decades. So I think this is a tried and trusted philosophy and process that we haven't changed. Now, over short periods of time, certainly we can be out of step with the market. I think that's all part of being a long-term investor. You want to have a portfolio that is very different and active. and that is certainly what you get with Pacific Horizon. We have big positions in the likes of Vietnam that is completely out of index, for example. And if you compare us to many other managers, our sort of largest overweight being materials would look very different. And we think that's right over long periods of time. But for 12 to 18 months, we can certainly be out of step with the market. But I think it comes back to our overall philosophy for Asia, which is this is a growth market, and the best way to gear into that is investing in the fastest growing companies. As I say, growth squared. That's what we've done for many, many years, and what we plan to continue doing. And as I say, I think Asia looks better positioned really than it ever has done in the past 10 or 20 years. It really is the Western markets that have behaved like the emerging markets. Asia is looking much better from a macro perspective. And if you're prepared to wait in the sort of medium to long term, I think that will be richly rewarded, particularly given where valuations are today.
Okay, and yes, the valuations would suggest that maybe a rebound might occur. A few questions, Roddy, on China. One viewer asks, with China growth slowing, are you too overweight in China compared to the rest of Asia?
In terms of sort of overweight, underweights, we wouldn't be overweight China at the moment, or there would be sort of overweight, I suppose, the Chinese consumer and growth. I think this comes back to your, firstly, investing in individual companies. We're not trying to just invest in China for some large macro call. We're investing in because it's genuinely got some of those innovative companies across Asia, currently trading at very cheap valuations. As I say, take Baillie that I mentioned earlier. I think you're getting all the interesting parts of the business for free at the moment, and these are in key areas like autonomous driving and AI. Even businesses like Alibaba, you're probably only paying 5 or 6 times P multiples for the core e-commerce business that generated $30 billion of revenue, of earnings, last year. So I think that's been great businesses trading at distressed valuations. So there's a lot of this in the price. And as I say, I don't think there's going to be some systemic major issue in China. They actually have a pretty strong economy and a lot of room to maneuver. And if and when they choose to do so, you could see a very significant re-rating of a number of those companies over the next 12 to 24 months. I actually think, strangely, China, we're very long-term investors. Our time horizon typically 5 or 10 years. I think China, in some ways, it's actually easier to be positive in the short to mid-term, i.e. over the next 3 years. The biggest issue for China really comes down to geopolitics, where it seems clear that the US is going to continue turning the screw on the country, particularly in key areas of technology such as semiconductors, etc. And that's probably the biggest risk for China. And I can only see that gradually escalating over the next 5, 6, 7 years. And that's probably the biggest cloud to the investment case for China. Rather than the outlook for the economy and the individual companies in the long term.
Okay. Well, Roddy, having raised that issue, what about the political situation in China? Well, I think you've covered that. But then he goes on to say they are a threat to the democratic West, which is, alluding to what you've just been talking about. Is there any more you can say about, that geopolitical overhang?
Yeah, I think it's complicated. But certainly it is the biggest long-term challenge. And actually, I don't think it's really what China does, or China being a threat to the democratic West. I think actually, if you look at what China's done over the past 2 or 3 years, it's actually been incredibly passive. It really hasn't done anything particularly aggressive outwardly to the US or to any of our allies. I think the bigger issue is really what the US does, irrespective of how China behaves. And ultimately, all the indications I see is they'll keep tightening the screws. We've actually commissioned a lot of work speaking to the DAJ, the Ministry of Defense, the intelligence services, and the financial regulators in the US. And the direction is clear. It is to make life more difficult for China, especially in key areas such as semiconductors, AI, quantum computing, military, etc. They want to inhibit them here. Now, the big question for us is, okay, they're going to make life more difficult from China, but are they actually going to make China simply uninvestable for, say, US or Western investors? And there, I think that's unlikely. All our work suggests that there are so many competing forces. Congress and the Senate might like to do so, but the administration less so. Big business is dead against that. And it's also a hugely complicated task how you go about enacting such changes. But the trajectory is clear and negative, but it stops short of any real drastic action. And I don't actually think there's much China can do about this. Politically, it works in the US across the political divide to be a China bear. So I think the policies will continue to tighten around China, which at the same time, for investors, actually gives a lot of individual opportunities. If you can find areas where China needs to be self-sufficient, it is and will continue to double down in those areas. So companies like Silicon that I mentioned earlier, where China needs to be able to get its own indigenous semiconductors, they should probably do very well over the next 5 to 10 years. But overall, that is the biggest headwind that China faces, and I don't see that disappearing.
Okay, thank you. Some questions on India now, if we could turn your attention back to there. Harsh said, actually, there's a question about Hong Kong. This is quite an interesting one, I think, before we get on to India. What is your view on Hong Kong stocks, and in particular on the reducing liquidity pattern experienced there?
Yeah, so we've got relatively little exposure to Hong Kong. It's really sort of Tektronix, which is actually a sort of a tool manufacturer, really exposed more to the US than Asia. And a couple of other smallish holdings, but it's an area where we find limited investment opportunities, and that's really got very little to do with any big macro calls on Hong Kong. It's simply that we have a very strong growth hurdle for any companies that we invest in. We want to be able to at least double our money over a 5-year time horizon from companies being able to grow. So we really want earnings of a minimum of 15 to 20% per annum. And we simply don't find many of those in Hong Kong today, particularly relative to other areas like Vietnam or Indonesia. So our underweight position to Hong Kong really is stock specific, if you like. In terms of the broader positioning of Hong Kong, I think it's certainly had a challenging period, but ultimately it's very clear that China needs Hong Kong to be a functioning entity. Remember, China has a closed capital account, and there is no way I see them wanting to end that over the next 10 or 15 years, and therefore they need Hong Kong to access the international markets. So it certainly still holds an important strategic position. So I think the overall financial space and economics of Hong Kong will be reasonable, but struggling to find decent stock ideas there. And in terms of liquidity, I think you're seeing issues with the types of company in Hong Kong not being that attractive, and also a number of international investors viewing Hong Kong as being or having issues with China, and therefore being less willing to invest. So liquidity is coming down.
Okay, thank you, Roddy. I'll turn to India now. Got 2 questions. Do you find better opportunities in large caps like banks or smaller, more innovative companies? And I'll run that alongside with what is your view on Indian banks? So large caps, banks, and smaller companies, please.
Actually, in terms of the market cap for India, we're really invested across the spectrum. We've got holdings in some of the largest companies in India, like Reliance, which is a couple of $100 billion, right down to very small companies, which like Skipper, which would have been a sort of less than $100 million when we first took a holding. So generally speaking, find opportunities across the spectrum. I suppose over the past 12, 18 months, probably slightly more opportunities in the smaller mid-cap space. But generally speaking, agnostic to the market cap, it's where I find the opportunities, and that's across the spectrum, if you will. In terms of the banking sector itself, I think India's probably got one of the most attractive private banking sectors across the emerging markets. Effectively, you have an industry which is 70% or so controlled by state-owned banks, the majority of which are terrible. I would say they are culturally bankrupt and very poor at lending. And that has meant that the private sector banks have been able to take a 1 or 2% share every year from the public sector banks, which means that they can grow significantly more from than the industry in a market that is fundamentally underbanked with low loans to GDP. So you've got very strong growth with a massive competitive advantage against most of the industry, which I think makes the private banks very attractive and actually not particularly expensive at the moment. The likes of HDFC Bank, arguably the highest quality bank in India, you're not paying much more than 2 times price to book for. So overall, I think the financial space, the private sector banks in India are very attractive. I would be very cautious about investing in the state-owned banks in the country.
Okay. Brilliant, thank you. I've got a couple more questions from the viewers, but geopolitics we focused on China's tensions with the US. So what happens if there's a war between China and India?
Well, I suppose always difficult to judge the hypothetical. It would depend on the scale of the war, what caused it, who was at fault. But clearly, it would be any significant military action between the two countries would be very, very serious. You're talking about 2 nuclear powers in a part of the world where that would have serious ramifications. So, not knowing what would be the cause of that war, ultimately, I think it would be very bad for markets, and you would probably see geopolitical tensions rise to very, very high levels. It would be a very serious event, which I should think would be hugely damaging for stocks across the region. I think that's the best that I could say.
Yep, fair enough, Roddy. And a last question then, I think, relating to Japan. What effect do you think Japan's changing approach to the yield on Japanese government bonds will have on the region? And perhaps you could explain some of the context to that question as well at the same time.
Yeah, I think it's difficult to have a strong view on that. In particular, it's not clear how strongly and for how long Japan will push its new monetary policy for. So I think I would probably take a wait and see approach to how that develops before giving a firm answer. It's an area I would probably keep an eye on, but wouldn't have any firm conclusions at this stage.
Any other comments around the use of borrowing by Pacific Horizon?
So the trust is currently ungeared at the moment. So it took the gearing off probably 18, 20 months ago. So currently ungeared. In the long term, our strong view is that Asia is a growth region, and therefore you probably want to be geared into that. So it probably makes sense to have some borrowing in the trust. So it's just a matter of timing, and with yields where they are, you're probably paying for US debt at the moment sort of 5% plus a spread. So it's probably 6 to 7% to borrow for the trust. It's not quite as attractive as it was a couple of years ago. So no gearing at the moment, but long term, my view is that you probably want to have some gearing, given the growth one is hoping for from Asia.
Brilliant, Roddy. Well, listen, that's all the questions we've got time for. But do you want to give us a quick summary or conclusion to leave us with before we go?
Sure. I suppose the conclusion is that remain very positive on the Asian region, particularly compared to developed markets. I don't think Asia has looked any better. It has behaved far more orthodox than Western markets. I think that will be rewarded over the next few years. And given the growth we're expecting from areas such as the rising consumer technology and innovation and the green transition, there are lots of exciting opportunities. And rarely would we be paying such a discount for the growth that we're seeing across the region. So overall, I'm very optimistic. And if Asia is going to perform, it will be within the next 5 years. So things haven't looked better, and I'm very positive on the trust and the region as it stands today.
Roddy, that's great. Thanks very much for summing up, and thanks for being with us today. I'm afraid that's all we've got time for, but thanks again to Roddy and to you for your time and all your questions. I hope today's session's been useful for you. It's certainly been an eye-opener to me on the kind of valuation opportunity in Asia at the moment. So if you found today useful, do keep an eye out for future broadcasts, as we have got a series of them coming up. But in the meantime, thanks very much from all of us, and good day and happy investing.